Hi, everybody, and welcome to this NEF Capital Advisors webcast, Where the Market is Headed. We'll be covering MSP and Data Center trends impacting M&A in 2017. I am joined today by Mike Murphy. He is the president of NEF, and I am also joined by Jim Farrell and Charlie McLravy, two men with about 20 years experience in the telecom industry. So we've got a lot of industry knowledge in this webcast with us today, and we're going to kick things off by looking at some macro trends in the IT space, and I'm going to hand things right over to Mike Murphy. Mike, as we enter 2017, what larger trends are you seeing emerge in the IT sector?
Great question, Brian. We're seeing a number of different things. It's a very exciting time in our industry, and what we're seeing is how information is being transferred and where it's housed has completely changed over the last 5 years. People talk about cloud and cloud infrastructure without really completely understanding how that changes the landscape of telecommunications, data center, interconnection, all of those things. So what used to happen, if you go all the way back to the beginning of the days of the internet, there was two interexchange points for all traffic in the U.S. There was May East and May West, East Coast and West Coast, and that's where all the traffic routed through. Over the course of time, we started to see more interconnection points, Ashburn and Equinix and Ashburn, Virginia, places like that. And major NFL cities were interconnection hubs, places like Chicago, Dallas, Atlanta, LA. And so what's happened with cloud computing is now things have become much more distributed. So we're less pinned down by these major interconnection points. And really, it's more about getting the content closer to the end user. So if you look at IT and IT infrastructure, the way we measure performance across a network is very different today than it was even a couple of years ago, where it's not so much about the metrics across the network, uptime and latency and different things. The paradigm has shifted now to be much more about the end user experience. And so what does that mean in the data center world? Well, what that means in the data center world is that these massive data centers that were in the same locations as the interconnection points, and that's where we saw high growth, has now shifted because now they need more and more points closer to the end user. So a great example would be Netflix. Netflix is responsible for about 40% of the traffic on the internet. Just Netflix, not video across the internet, but Netflix video. And so what they had was a cloud-based system through AWS that allowed them to distribute all of their video. They found that it was inefficient, so now they're starting to put the video, the top 10 pieces of content that is responsible for probably 80% of the traffic, they're putting those in the local areas. So now we see places where data centers really, were small and kind of out of the way and probably didn't have high value, now are high value because a lot of these companies that need to distribute content need to go into areas that are not traditional data center areas.
And Mike, how has the expansion of cloud altered the physical distribution of data?
Yeah, that's a great example. It's kind of playing back into, the things we were just talking about there with where content is located. I think what we're going to see in the cloud marketplace, very similar to telecommunications. If you go back to the telecommunications, marketplace of 10 years ago, after the dot-com bubble burst, there's a lot of different companies. It was fairly fragmented and a number of different fiber providers. Over the last 10 years or so, we've seen massive amounts of consolidation. Companies like Zayo buying 15 or 20 different regional fiber players and creating a national footprint based on that. In the cloud marketplace, we don't see today as much consolidation, and we see some bigger companies, but they've grown fairly organically. I think in the next 5 years or so, we're going to start to see a lot more of the roll-up strategy. And so the regional cloud companies that have, profitable businesses and a pretty standardized platform and offering are going to be acquisition targets. And so we'll see some of the companies. We're already starting to see some of that through, our own dealings with our clients. And I think that will continue as 2017 moves forward. We'll see more consolidation of small and medium-sized cloud providers to form a larger entity.
Thank you very much, Mike. And I'm going to pass it over to Charlie now to kind of tie that all together for us. Charlie, can you tell me what impact all this has on data centers and IT businesses in Tier 2 and Tier 3 cities?
Thanks, Brian. We're seeing heightened interest in these smaller markets, these non-NFL cities. We've done a number of transactions in cities like that, and companies that formerly wouldn't have any interest in a market this size now have interest. We're also seeing companies that operate in this size market want to acquire similar companies, probably in within the same region at least, so they can expand what they're doing. What we do see is that most of these companies have a geographic footprint that probably extends maybe 100 miles from their city, and for them to expand, it really helps if they can really buy another business in the same region, but in the next market over, maybe there is also some consolidation going on in the same market, where if you get same market like Kansas City, somebody there may want to buy a similarly sized business.
Thank you, Charlie. We're going to switch gears here a little bit and focus on some buyer trends, and we're going to hand things over to Jim Farrell. Jim, consolidation is obviously a continuing trend disrupting the space. You're out talking to buyers on a regular basis. So tell me, how have you seen buyers' interest shift in the past year?
That's a good question, Brian. I think with the accelerated adoption rate of cloud and virtual services, buyers are increasingly looking to find companies that service their client base out of or from the data center or cloud versus working on customer prem. Buyers also prefer businesses with a majority of revenue that's being contracted monthly recurring versus the older, more traditional break-fix model that was non-reoccurring.
And what are buyers looking for when they're looking at businesses in the $3 to $15 million range?
Well, I would say that there's a number of things. So there's, first of all, a high demand for profitable MSPs with a track record of double-digit growth over the prior 3 years. Buyers expect MSPs to generate around 40 to 50% on a gross margin and somewhere around 20 to 30% net margin. Headcount, given that it's typically the most expensive line item or cost for business, MSPs generally should use a metric of $250,000 of top-line revenue per employee. If you use that metric, then you'll ensure that you're getting maximum production per head count, and just to ensure that you're not running either too lean or too heavy in terms of staff. The other point I think that's really critical is to plan ahead. And if you're contemplating an exit, either partial or fully, start now to plan ahead, and even if it's several years down the road that you anticipate a transaction, identify what a successful transaction would look like, and then work with an advisor to help you identify where your business is relative to where you need to be based on your goals and objectives, and then to develop a plan to bridge that gap, and then that'll help you determine when it's the right time to seek a transaction. Some of the areas I would also say the business to focus on when you're contemplating exit would be to standardize and simplify your product set. Have things less custom and one-off and more consistent, clean, and streamlined. Churn, and in some ways you could say fire unprofitable customers, clients that aren't good customers, a good fit for your firm. Better to let them move on and focus on the customers that are a fit and they're productive and profitable for your business. Develop a formal sales and marketing plan, complete with the forecast and funnel, and have that implemented and being used on a regular basis. I would also say to reevaluate staff. Make sure that you've got the right people in the right place, in the right job, I should say. And as need be, terminate and hire in order to make those adjustments to optimize your staff. Documentation is also very important, be it financial, human resource, strategic plan, employee handbook, training, etc. Documenting things fully and standardizing them demonstrates that you're a business that is able and ready to scale. And that's particularly of interest to buyers looking to acquire your company and take it to the next level. I think it's also helpful to develop a set of what's called KPIs, key performance indicators. These are just measurements that are specific to your business that help you to really manage and monitor the growth and trajectory to make sure that you're achieving the goals that you've set out to achieve. Those are very, very useful for executive leadership team. I would also advise, if you don't already have a CPA, retain one and have them get to work on generating financial statements for the 3 prior years. Having good, clean books that are certified by an accountant is important, particularly as you pursue a transaction. And finally, I would say a year or so prior to your planned sale, I would start to shift focus from sort of running and growing the business to optimizing your EBITDA. Some of the things that you can do to help that might be deferring capital investments. If you have an ongoing need to deploy capital to support growth and ongoing operations, consider perhaps leasing versus using cash in order as a means to fund those needs of the business, and also to cut costs where they make sense. Doing that to the extent possible will really help you to get the business looking as good as it can look, and thereby maximize its value once you do go to the market.
All right, Jim, and what subsectors are experiencing the most consolidation right now?
I really have seen a lot of consolidation in M&A activity and MSPs around the $3 million top-line revenue and below. Some firms interested in selling. They're looking to become part of a larger firm. Perhaps they're technologists. They've grown a nice little business, and they want to see it continue and be a part of it, but don't really want to be in the CEO role. So they're looking to sell to a larger competitor in order to take some money off the table and potentially retain some ownership, and, as I said, continue on with the acquiring firm in a vital role. And then you see sort of the flip side of that would be slightly larger firms, we'll say between $3 and $10 million, that are looking to acquire $3 to $5 million companies in order to either enter a new market or increase the penetration rate within their existing market. Particularly if it's an operator that's in market, they can simply acquire the customers, the employees that make sense, and really shed much of the costs and optimize the revenue pretty quickly.
Thank you, Jim. Now we're going to pass it back over to Charlie McLravy for a moment, starting to look forward a little bit. And Charlie, if you could tell me some of the trends or predictions that you have for the data center market in 2017 and beyond.
There used to be a really defined market for space and power data centers, MSPs, and then as the cloud came along, that started to blur. And then now we're seeing really a number of companies. There are very few strictly space and power data centers anymore that don't offer a cloud, and the ones that don't are generally in the process of bringing one on. A number of MSPs are now have their own cloud so that they can deliver their services that way if they didn't have that before. And I would say in general that we're seeing a blurring of the lines between traditional data centers, cloud providers, and MSPs because the services need to be integrated. We do have a number of MSPs that rent space, and I think that will continue. But on the data center side in particular, they are adding more services because having a space and power footprint just isn't enough.
Thank you, Charlie. And now, one last time, we'll hand things over to Mike Murphy. Mike, from a cloud adoption and product perspective, what trends do you think we'll be seeing in 17?
More of the same in some ways. I think the adoption of people moving things to the cloud. And, just to stop for a second and define what is the cloud. Cloud is really distributed computing. So you're saying things that used to live on site no longer live on site. So things like phone systems and email servers and different things have now been moved to a managed service provider. What we're starting to see more of is larger scale deployments within companies where they're moving all of their storage, all of their mail, and so we're seeing a growing trend there. And I think that will continue through 2017. So the adoption will be, I think, accelerating in growth. Right now, about 95% of all companies have something in the cloud. But in most companies, 80% of what their IT infrastructure is still lives on site or in a more traditional data center. I think we'll see more of that shift where over the next 5 years, it's projected that it'll be more of a 50-50 split between traditional infrastructure and cloud infrastructure. From a product standpoint, there's still quite a bit of immaturity in the cloud marketplace from a product perspective. It hasn't really completely become commoditized, but I think certain products will start to, and especially if we see consolidation in the marketplace, will start to become much more standardized. And I think as things become standardized, it becomes a lot easier for people to understand how to navigate the change from the infrastructure that they have today to a cloud-based infrastructure. And so I think with the way we are today, the managed service provider that is providing cloud services to their client is still very valuable. As time goes on, 5 years down the road, when things become very, very standardized, it's almost like system integrators of the days of old. When you get an internet connection, you had to hire a system integrator, and they'd have to come out and program a whole bunch of different things and add IP addresses and hook up printers and all that great stuff. Now, if you think about how commoditized the internet space is, Comcast or Verizon Fios, whoever it is, will ship you a piece of equipment many times, and you plug it in and it auto configures. I think we'll see that further down the road with cloud. But in the interim, I think that companies that offer managed services and the ability to help migrate things to the cloud are of great value.
All right, and that's all we have for today. Thank you to Jim, Mike, and Charlie for taking the time out to join us today. And thank you to our listeners. Be sure to stay tuned for more market updates from NEF Capital Advisors.